Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Whoo, yeah, inflation. So inflation came in at 8.6%, which is more than what economists expected yesterday, which is what we said, at 8.3%. That was the expectation. It came in a little bit hotter than that. The market responded by dropping by 800 points. The Dow Jones dropped 800 points, which is not great. However, the blueprint is here. I think we have a clear blueprint as to what we need to do as investors, and I'm going to describe exactly what that is in detail, and you're going to see my portfolio evolve at the end of this year doing exactly that. So this is what we know. Okay, inflation is up. It's probably going to be here because the two main factors that have resulted in the current inflation environment are two things that the United States can't really control. The Federal Reserve cannot control these two factors. So factor number one is China. They are still doing a zero COVID lockdown. So you get one case, the entire town, the entire plant, whatever it is shut down. Well, last I checked, most things are made or manufactured in some part in China. And that includes Nike shoes, includes iPhones, and everything in between. So when they're not producing, we don't have enough supply, which means we have an imbalance in supply and demand. Lower supply, higher demand, prices go up. And until that is solved and resolved, that's going to persist. The Federal Reserve can't do anything about that. That's just it, right? That's half of the equation. The other half is in Russia and Ukraine, and without Russian oil, that is hurting or increasing the cost of everything across the board, including in Europe, which is an interesting tweak there, which we'll talk about. And that makes oil more expensive and makes it more expensive for us to fuel our own cars. Now, here's the thing. The United States rather, does not import that much oil from Russia for gas. We actually don't. I think that was less than like 10% or so in 2021. We got enough oil to be fine on our own. However, our European allies do not, and we've been sending more oil and natural gas and all that stuff to them in ways that we had not done previously. So again, lower supply, higher demand, higher prices. That is what's going on. But again, Federal Reserve does not control that at all. So we can only control interest rates. Federal Reserve rather can only control interest rates, and so far this year that ain't exactly working to cool down prices. That is the issue we're in. Now, for your portfolio, I think there are, again, two ways that you should play this, and it's really an interesting balancing act that I think you have to attack or manage in this particular environment. So I'll talk about a little bit about my portfolio and how I'm kind of looking at things as I'm approaching my own moving day. Moving day for me, for those that don't know, is when I sit down and say, hey, I am adding this thing and taking out this thing and moving things around in my portfolio. So I'm looking at let's just call it a top and bottom strategy, in that I want a good bottom, a good base for my portfolio that I know is, I don't want to say recession proof, but generally performs well during recessions, that is solid, that I know is not going to go anywhere, that pays me a solid dividend. That's what I want as the bottom, the base of my portfolio. So maybe that's Coca-Cola, perhaps that's Hershey. Hershey was up. In fact, there are only 19 stocks that were up in the S&P 500. That's what I counted. Only 19. Hershey's was one of those. Kroger was another one of those, and Walmart. So maybe companies like that form the bottom. They're not going anywhere. They usually, not all the time, perform well in inflationary times. Usually perform well in recessionary times. Usually, that's not always the case. So build my portfolio there. Have those things set in stone, if you will. Maybe I'll throw in a Dollar General or what have you. Have that there, and then take advantage of the companies that I know are going to do well when this thing starts to resolve itself. It may be a year, it could be 2 years, but I know Microsoft's not going anywhere. I know Apple's not going anywhere. I know Google's not going anywhere. Stuff like that that happened to be down in a year like this, that's where I'm scooping up those. So it's really, I got my dividend, my base, and then I've got those companies that have been stars in the past and that I don't see just automatically disappearing based on what we have now. The companies in the middle, I think those are the ones that are the fastest candidates to get rid of. So my portfolio right now, the first candidate to just get up out of here is something like Intuit. Intuit is not Apple. Intuit is not Microsoft. It is not, while it is a good, solid company, and prior to now it was doing quite well, I don't really see that as a foundation of, I'm not going to say foundation of America, but a foundational market company that is going to be here and is always going to be here. And if it's not here, the world is completely different. Microsoft is like that. Microsoft is definitely that. Like, what would the world be without Google? That would be a strange place, right? We would all be on Bing, which is owned by Microsoft. So aside from stuff like that, that's where I want to build my portfolio, and that is the best way I think that you can to move throughout the market, at least for the rest of this year and probably definitely into 2023. You can get your dividends, you can get your solid portfolio of companies that play defense, but also set yourself up for the future for getting companies at steep discounts that are still going to be around. Those middle of the road companies, I'm trying to think of what else is in my portfolio that's middle of the road. But Intuit, PayPal, and Square, perhaps, even though I like them long term, I don't really like them right now. But if there's a company that you're like, you know what? I don't know if that's going to be like the thing. I don't know if it's going to still be here. If it's going to be like a foundation, those got to go. Right, I think those are question marks that you don't need in your portfolio, given what we have now. Because right now, what has been the playbook is not working and has not worked. So you need to change your portfolio just a bit. That is not a sell everything and go. I do not think that is the case. It is, how can I get some small wins now, dividend stocks, defense, and how can I set myself up for 2023, 2024, 2025? These are the opportunities. The people who went back and let's say in 2020 and said, oh, I'm buying as much Apple as I can. I'm buying as much Microsoft. I'm buying as much Tesla for some people. They're still set up quite well. Some of those people are still up 60% going back to 2020. So it's hard to take these losses. It's not fun to look at your portfolio and see that you're down 20% in 2022. It is not. But there are some ways to lower that just a bit. And the ways to do that, buy defense and then look for value. When I say look for value, it's a good company, undeniably good company that is down on the cheap. For example, for me today, I bought a good chunk of Microsoft because it fell right into the area that I wanted to get it at. And y'all know that I like Microsoft for the long term. I even did an entire video, a live video in fact, where I showed those in the membership group exactly what I was buying and why, based on price charts and all that kind of stuff. So you want to check that out, go ahead and click the join now button for the membership group. But that's the best way to play this right now. So anything that is in the middle, a company that is not doing well and that you don't think is a foundational piece and is not a defensive company, I don't think that's the best place to be. Okay, so it is clear there are two. I put up 4 fingers, but there are 2 ways to do this. And I think if you go all defense and you go all conservative, that's an okay route. I think if I'm closer to retirement, I would probably do that. But you don't want to overcorrect. And I think that's the thing, because when you never know when the market is going to recover. Well, I don't think it's going to recover this year, but you don't know when the market is going to recover, and you don't want to have all defense and the market takes off, and then you're looking like, how long do I wait to change everything out? So it's really meet in the middle. Have a good defensive base. Have good offensive value for when things do change. So that's how I'm looking at the market. So we can do some more videos if you want me to kind of put together some list around what I think is valuable and what I think is more defensive. Feel free to let me know in the comments and we can do that. All right, so that is it for me today. I got a whole bunch of work that I need to do over the weekend in terms of recording some more content and helping you manage through this time. The last thing I'll say, and I feel like I keep saying this at the end of every video, but June 14th and 15th, which is next week, last time I checked, we're going to get some announcements from the Fed. They're going to say something about inflation. I don't know what, but the market is going to react to that, which I think is next Tuesday and Thursday, or Thursday and Friday. Let me double check that real quick. That's next Tuesday and Wednesday, the 14th and 15th. And then you go right back into earnings season. So we already had our inflation numbers. Told you about that. The market did react, not in a good way. And then we have Tuesday and Wednesday. We're going to see what the Fed says. And the market's going to react. I'm not going to sit here and tell you that's going to be good or bad. But I am expecting, I'm expecting some stuff when it comes to that. And then we hit earnings season. So it's going to be a lot of stuff moving and shaking. So be ready. Don't overreact. Have a game plan and start to plan out what moves are you going to make. Defensive and value. I think those are the two places that you want to be. Anything in the middle is not the place that you want to be. All right, that's it for me. I'll talk to you later. Bye.